Look at your brokerage account right now. Like, open the app on your phone.
Yeah, pull it up.
Scroll right past that top line number. I want you to look at the actual funds you own. You probably have a value ETF in there,
Oh, almost certainly.
right? And you definitely have a small cap ETF. I mean, you bought them because the smartest guys in finance told you to do it.
The literal Nobel Prize winners told you to.
Exactly. They said these were the absolute bedrock of wealth building. So you think you're diversified. You think you bought fundamentally safe, undervalued companies.
But I mean, what if you didn't?
Yeah, what if I told you that you didn't buy value at all?
What if
What if I told you that you just accidentally bought a massive concentrated pile of bankruptcy risk?
It's a terrifying realization. You really think you're analyzing a company's balance sheet, you know?
Right.
But you're actually just standing blindfolded on a macroeconomic fault line.
That is just a massive slap in the face. And today, we are completely dismantling that foundation. We are going after the holy grail itself.
The Fama-French three-factor model.
You worship it, Wall Street worships it. But the brutal truth here, the size and value factors you chase, they're ghosts.
They are completely cheap stand-ins.
They're decoys. And they are hiding a much deeper, much more violent market force.
So today's deep dive is based on a landmark 2006 paper by Ralitsa Petkova.
She's an associate professor at the Weatherhead School of Management.
Exactly. The paper is titled, Do the Fama-French Factors Proxy for Innovations in Predictive Variables? And honestly, the answer fundamentally changes how you have to view your money.
This deep dive is going to be heavy. We are stripping away the whole illusion because we aren't looking at risk the way your standard financial advisor teaches it.
No, not at all.
We are hunting down the hidden surprises, the unexpected macro shockwaves that actually control your portfolio.
Because, frankly, in a real crisis, your hard-earned wealth codes are completely worthless.
Totally worthless. So let's talk about Petkova's research. She specializes in this thing called IKM.
Right, the intertemporal capital asset pricing model.
It's a framework that looks at how investors hedge against future uncertainties, right?
Yeah. And what she proves is that the Fama-French model, despite its massive fame, is essentially a black box.
It works on paper, but the actual economic logic, total mystery.
Exactly. It's an empirical observation with no real soul.
I want to make sure we ground this right away with an analogy.
Huh?
So Fama and French noticed that whenever it rained, people carrying umbrellas got their shoes wet.
Right.
So they looked at the data and concluded, umbrellas cause wet shoes. We should buy an umbrella factor.
Which is obviously absurd.
Right. Petkova came along and said, no, umbrellas are just a proxy. The massive storm system is what actually gets your shoes wet.
Value and size are just the umbrellas.
And today, we are going to show you the storm. So let's unpack the history first. To understand why this paper is such a total bombshell, we need to drop right into the Game of Thrones of quantitative investing.
The early 90s.
Yeah, take us back to 1993. Picture a giant pyramid in your mind.
At the bottom of that pyramid, you have CAPM, the capital asset pricing model. For decades, it was the single ruler of finance.
CAPM basically stated that the only risk that mattered was market risk, the beta.
Right. If a stock jumped around more than the broader market, you demanded a higher return. Simple, elegant,
and completely broken.
Utterly broken. By the late 1980s, the data was literally screaming that CAPM was wrong. Academics were finding anomalies everywhere.
Like small cap companies absolutely crushing the market, etc., adjusting for beta.
Exactly. And companies with high book-to-market ratios, what we call value stocks, doing the exact same thing. CAPM couldn't explain it.
It was a single-factor model completely failing in a multi-factor reality. So enter Eugene Fama and Kenneth French.
They literally kicked the door down.
They shattered the single-factor market entirely. In 1993, they introduced two new kings to rule alongside the market factor.
HML and SMB.
Okay, for you listening, if you know the terms but haven't looked at the actual math lately, let's translate this. What exactly is HML and SMB in the real world?
Let's start with HML. It stands for high minus low. It's the value factor.
It tracks the book-to-market ratio.
Right. So book value is what the company's assets are worth on an accounting ledger, the hard assets. Market value is what the stock market says the company is worth.
So if a company has a high book-to-market ratio, the market is pricing it basically at its liquidation value.
Yes. Think of an old steel mill.
Oh, good example. So it owns massive factories, blast furnaces, tons of land. That's a huge book value.
But everyone thinks steel is dying, so the stock price is just in the gutter.
The market value is tiny. High book divided by low market equals a high ratio. a classic value stock.
Exactly. Now, contrast that with a low book-to-market stock, like a massive software startup.
They own like some laptops and a rented office. Tiny book value.
But the market thinks they'll conquer the world. So the stock trades at $100 billion. Massive market value.
That's a growth stock. Low book to market.
Right. So HML simply tracks the performance difference between a basket of those old steel mills and a basket of those high-flying software companies.
Okay, and SMB, small minus big.
That's the size factor. It just tracks market capitalization. It measures the return of very small companies minus massive mega cap companies.
And Fama-French proved that if you add HML and SMB to the market factor, you suddenly explain almost all the differences in stock returns.
They ruled Wall Street with that math.
For a decade, they were totally untouchable. I mean, you couldn't even launch a mutual fund without paying homage to the three-factor model.
But there was this massive dark shadow hanging over their entire kingdom.
The shadow was the why.
Exactly. Fama-French found a mathematical pattern, but did they find an actual economic reality?
Right, like what do value and small cap represent in terms of visceral risk? Why should you demand a premium for holding an old steel mill just because its accounting book value is high?
That is the core vulnerability of their whole theory. Are these real fundamental risks? Or are they just a massive, lucky data mining hallucination?
Because you have to remember the explosion of computing power in the 90s.
Yeah, suddenly academics had millions of data points and incredible processing power. If you torture historical data long enough, it will confess to absolutely anything.
You can find patterns in static, but a pattern in a spreadsheet is not a reality in the economy. Which brings us to this legendary warning in finance.
The curse of the fishing license.
Yes. Introduce us to John Cochrane. Picture this, a brilliant academic sitting by a massive rushing river of data.
Cochrane is a giant in asset pricing. Around 2001, he looked at this crazy explosion of factors being discovered.
People were finding that everything from momentum to random accounting ratios predicted stock returns.
And Cochrane just mocked this relentlessly. He warned the academic community that they were completely losing the plot.
He basically said, theoretically, you could find any random variable that loosely predicts the future and call it a risk factor.
He called it a fishing license. You
Now,
can't just grab a license, head to the data river, fish out some macro data, run a regression, and say you've solved the stock market.
hold on, let me make sure I'm getting this logic, because this is mind-blowing.
Sure, go ahead.
If I do a massive study right now, and I find out that global ice cream sales in July perfectly predict the stock market returns over the next 10 years. I have the data. The math is flawless.
Okay.
Are you telling me that ice cream is not a financial risk factor?
I am telling you exactly that. Ice cream is not a risk factor.
Wow.
It is statistical noise. It's an accident of the sample size. A true pricing model cannot just be an observation of correlation.
It demands strict structural economic logic.
It demands a real mechanism. And in modern finance, that mechanism is defined by ICPM.
The intertemporal capital asset pricing model. Let's break that down for you listening. Intertemporal. Between time periods.
Yes, Robert Merton developed it in 1973.
Yeah.
ICPM basically says investors don't just care about the wealth they have today.
They care about their investment opportunities tomorrow.
Exactly, they are investing across time. So the only things that should carry a risk premium are assets that perform terribly when future investment opportunities become terrible.
Right, you want a stock that protects you when the world gets dark. If a stock falls exactly when the broader economy is crashing, that stock is highly risky.
And you demand a massive premium to hold it. But ICPM has this incredibly strict, brutal requirement for what counts as a measure of the future.
It's not about the level of the economy, right? It's not about what the weather is today.
It is entirely about innovations.
Innovations.
Mhm.
Okay, this is the magic word for this entire deep dive. If you're listening to this, forget everything you associate with the word innovation.
Yeah, we aren't talking about the latest microchip or a startup.
No. In quantitative finance, an innovation is a pure, unexpected shockwave.
It is a sudden, violent surprise.
A shockwave. Explain the mechanics of that. Like, how is a shockwave different from just a normal change in the data?
Let's use interest rates as an example. Suppose the Federal Reserve clearly communicates they are going to raise rates from 4% to 5% over the next year.
Okay, everyone knows it. It's in the news.
Right. That trajectory is the expected path. The market, which is a highly efficient discounting machine, has already priced that 5% reality into every single stock today.
So when rates actually hit 5%, literally nothing happens.
Exactly. The level changed, but there was no surprise. The risk, the real portfolio-ruining risk, is the innovation.
It's the morning you wake up expecting 5%.
And the Fed holds an emergency meeting and hikes rates to 7% because inflation exploded.
Oh, wow. So that 2% difference between the expected 5 and the actual 7, that's the innovation.
That is the shockwave. It is
Yeah.
the residual error of a predictive model.
And if a financial model doesn't capture those shockwaves, it's just garbage.
It's just predicting the past. ICAPM dictates that real risk factors must be tied to innovations in state variables, variables that describe the future economy.
And this is where Fama-French gets brutally exposed. Because Fama-French didn't have shockwaves.
No, they didn't look at the macro future at all.
They just looked at the characteristics of the companies right now. The paint job of the car. Company size. Book value.
They assumed size and value were proxies for some unknown distress risk, but they never actually identified the distress.
They just said, well, the math works, so let's use it. So imagine the Fama-French king getting dethroned right now. The crown is literally falling.
It's a massive shift.
If we throw Fama-French in the trash, what actually replaces them? If size and value aren't the real risks, who steps up to the throne?
4 invisible hands.
Meet the real masterminds. Picture a machine with 4 precision gears. These are the macroeconomic gears actually running the global financial system.
Petkova didn't just guess these. She went to the foundational literature of IKPM and selected the 4 most robust variables for the future economy.
Gear 1, the dividend yield of the market. Gear 2, the term spread.
Gear 3, the default spread. And Gear 4, the short-term T-bill rate.
I want you to look closely at those 4 variables. What do they all have in common?
They aren't about tech earnings or retail sales.
No, they are all about the lifeblood of the system itself. They are all about money.
The price of money and the spread of money. Let's walk through them because this is the architecture of our reality.
Let's do it.
The short-term T-bill rate. That's the raw baseline price of short-term cash, the foundation of liquidity.
When the T-bill rate shocks upward, cash becomes suddenly very expensive. The oxygen just leaves the room.
Exactly. Gear 2 is the term spread. The difference between the yield on a long-term 10-year Treasury bond and a short-term 1-year Treasury.
It measures the slope of time. Why does the term spread matter so much? Make it visceral?
Because the entire banking system is built on it. Banks borrow money at short-term rates, and they lend money out at long-term rates.
Like a 30-year mortgage.
Right. If the term spread is wide, meaning long rates are much higher than short rates, banks make a massive profit. They lend aggressively, the economy booms.
But if the term spread gets a negative shock, if it flattens or inverts,
meaning short-term rates suddenly spike higher than long-term rates, the banking model breaks. Lending completely freezes.
an inverted yield curve is literally the most reliable predictor of an economic recession. It is the pulse of future growth.
Gear 3 is the default spread. This is the premium for bankruptcy risk.
The difference in yield between a safe, AAA-rated corporate bond and a risky junk bond.
It is the literal smell of fear in the corporate debt market. When it widens, investors are terrified companies will default.
And Gear 4 is the dividend yield, the aggregate cash flow payout of the entire stock market.
Right. When prices crash, the dividend yield spikes, signaling a higher expected risk premium going forward.
But remember Cochrane's fishing license. You can't just take these 4 variables and plug them into a model.
That's just looking at the weather. Petkova's genius was not just picking these 4. She didn't use their daily levels.
She built a vector autoregression model, a VAR model,
to predict their expected paths. And then she stripped away the expected path entirely.
She threw away the predictable part of the economy and kept only the pure panic.
She isolated the pure, unadulterated surprise shockwaves of each of the 4 variables.
And then she performed a surgical strike. She put the mighty Fama-French factors into the exact same statistical room as these 4 pure shockwaves.
To see how HML and SMB reacted to the invisible hands.
This brings us to Table 1 in her paper. This is where the disguise is violently ripped off. This is a shocking revelation.
She ran the data from 1963 to 2001. She looked at how the Fama-French factors correlated with the unexpected macro shocks.
And she found something impossible to ignore. Let's look at the legendary value factor, HML, the absolute darling of Warren Buffett disciples everywhere.
The strategy of buying fundamentally strong, underpriced companies.
Petkova's data show that HML is highly positively correlated with innovations in the term spread.
Let that sink in.
I have to translate this because it's a massive face slap to conventional wisdom. You think you are buying a value stock?
You think you're buying that old steel mill because the market is just temporarily ignoring it.
You think you are a genius stock picker finding diamonds in the rough.
But you are not. The data proves it. Value stocks are not a unique category of brilliant investments.
They are a mutant variation of term risk.
They are simply interest rate shock absorbers. Their outperformance is entirely explained by how they react when the yield curve twists violently.
It is exactly like pulling off a villain's mask in a movie.
Right?
You're fighting this monster. You think it's called value risk. You struggle with it. You build your retirement around it.
And Petkova pulls the rubber mask off.
And underneath, it was just the term spread shock wearing a terrifying costume the whole time.
You thought you were fighting a ghost called value. You were actually fighting the Federal Reserve's impact on the yield curve.
We have to go much deeper into this. Because stating that value is term risk is one thing, but we need to explain the actual mechanics.
The bloody truth about value in small caps.
Yes, because you listening to this, you think value stocks are safe, they're steady, they pay dividends, they survive recessions.
Completely wrong. The mechanism here is crucial. Value stocks are not safe bunkers. In fixed income language, they are low-duration assets.
Translate that. Make the math of duration visceral, because we usually only talk about duration with bonds.
Think of a bond. A 30-year long-term bond pays you far out into the distant future.
Right.
Because you have to wait 30 years to get your principal back. The current price of that bond is highly, highly sensitive to changes in long-term interest rates.
That's a high-duration asset.
Exactly. A one-year short-term bond pays you right now. It's low duration. It's mostly sensitive to what the Fed is doing with short rates today.
Okay, now apply that to the stock market.
A growth stock like a massive tech company promising revolutionary AI might not make any real profit today.
They promise massive cash flows 10, 20 years from now.
They are high-duration assets. Their value is almost entirely weighted in the distant future. They act like a 30-year bond.
Okay, now look at a value stock, that old steel mill.
It's not growing. It's making a boring, predictable profit right now. Its value isn't based on some distant futuristic promise.
Its value is trapped in the present day. Therefore, value stocks are low-duration assets. They act like a one-year short-term bond.
Exactly.
So why does that matter? Why is that so dangerous when a macro shockwave hits?
Because it makes them hypersensitive to the short end of the yield curve. Remember, Petkova found value covariates with innovations in the term spread.
When the term spread gets a negative shock, meaning short-term rates suddenly spike upward, it flattens or inverts the curve.
The bad times reality. A flattening yield curve signals a bad economy. Credit is tightening.
And in these bad times, the short-term rates move violently.
And because value stocks are low-duration assets whose cash flows are heavily weighted to the present, a spike in short rates violently discounts their present value.
They're standing right on the fault line of the short-term rate earthquake.
And your returns just bleed out. You bought them for safety, and they are the first to get slaughtered.
Ironically, those high-flying, supposedly risky growth stocks.
Because they act like long-term bonds, their cash flows are so far away that a short-term rate spike doesn't hurt their valuation as much.
They might actually weather a term spread flattening better than your safe value stocks.
You are literally scrapping dynamite to your portfolio, and the detonator is the Fed's short-term interest rate policy.
The value premium isn't a reward for buying good, cheap companies. It's hazard pay for holding assets that will get crushed when the yield curve inverts.
It is entirely dependent on the term spread, period.
Let's pivot to the tragedy of small caps.
Wow.
The size factor, SMB. People absolutely love small caps.
Oh, every advisor says you need a small cap allocation.
They think they're buying the next Amazon. The soul of the small cap factor must be agility, right? Massive growth potential.
It is none of those things. The soul of the small cap factor is weakness.
Weakness. That hurts to hear. Small businesses are the engine of the economy.
They might be the engine, but structurally, they are incredibly fragile. Petkova strips away the romance completely.
She proves in Table 1 that the small cap factor is tied directly to the default spread innovation.
The risk of corporate bankruptcy shockwaves.
Yes. When the default spread gets a positive shock, when junk bond yields spike relative to safe treasuries, the market smells blood.
The credit window is slamming shut.
Explain how this targets small caps specifically. Let's look at a marginal company.
What is a typical aggregate small cap company in the index? It's not a brilliant Silicon Valley unicorn.
It's a mid-tier regional manufacturer, a marginal company.
Heavily leveraged, Garbage, inconsistent cash flow, surviving month to month by rolling over short-term bank loans.
They don't have billions in cash sitting around like a mega-cap tech giant.
No, they are surviving on the edge. So a macro shockwave hits, the default spread widens, banks panic.
They stop lending to risky companies. They demand higher interest rates to roll over existing debt.
The mega-cap tech company doesn't care. They fund operations with cash reserves.
But the small, marginal company?
Slaughtered. They have no cushion. Their interest expense doubles overnight, wiping out their tiny margin. They simply go bankrupt.
Stop right there. I need to push back. I need to make sure you listening grasp this completely.
Sure.
Are you telling me that when I log into my Vanguard account and I buy a broad small-cap index fund, I am not buying nimble, growing companies?
You are buying a giant, concentrated pile of bankruptcy risk.
That is insane.
That is the empirical reality of the SMB factor. You get paid a premium because half of them are constantly teetering on the edge of insolvency.
The size factor is just a shadow of aggregate corporate credit distress.
When you buy SMB, you are acting as an insurance company selling default insurance, picking up pennies in front of a steamroller.
If a default shockwave hits, you get completely flattened.
Mind-blowingly elegant, isn't it? Value is just term risk. Size is just default risk. Fama-French just accidentally stumbled onto proxies for interest rates and bankruptcy rates.
They found the shadows, not the objects casting them. But finding correlation in Table 1 isn't enough.
No, we have to prove the shadows are worthless once the real objects enter the room.
Which brings us to the climax of Petkova's paper, the factor massacre.
Table 2. The cross-sectional regression. This is where the academic politeness ends and the brutal math begins.
Explain a cross-sectional regression for us. Let's use a detective analogy.
Imagine a police lineup. You have a crime. The variation in the stock market returns across different portfolios. You need to find out who committed the crime.
Who is driving the returns? You put the suspects against the wall.
Suspects 1 and 2. The Fama-French factors, value and size. Suspects 3 through 6. The 4 pure macro shockwaves.
Dividend yield, term spread, default spread, T-bill rate.
You run a regression which interrogates them all simultaneously to see who has real explanatory power.
It's a brutal stress test. The interrogation begins. What happens?
It is a bloodbath. Petkova runs the regression, and the moment the 4 surprise macro variables enter the room, the Fama-French factors drop to 0.
Wait, literally 0?
Statistically insignificant. Their premium vanishes entirely. The math says they have absolutely no independent explanatory power.
The market stops caring about them entirely.
Because the macro surprises explain everything the Fama-French factors were trying to explain, and they do it vastly better.
When the actual storm enters the room, you don't need to look at the umbrellas anymore. The proxies are dismissed.
The old kings are dead.
Let's look at the scoreboard. Petkova compared the sheer accuracy of the models using adjusted R-squared.
Right. R-squared measures how much of the reality the model actually captures. 100% is perfect prediction.
For a decade, the Fama-French model was the undisputed champion of the world. What was their peak score?
71%.
71%. Incredible. But Petkova runs her pure innovation model, only the 4 macro shockwaves. What does she score?
77%.
77%. It beats them by a massive 6%. But here is the absolute knockout punch for you listening right now.
Petkova hits 77% accuracy without ever looking at a single company's size or book value.
Her model is entirely blind to the corporate balance sheet.
It doesn't care if the company makes microchips or discount shoes. It never looks at the accounting. At all.
It completely ignores the very things Fama-French said were the most important metrics in the universe.
Because her model is looking at the environment, not the subjects. The gravity of the macroeconomy, rather than weighing individual apples.
Let's paint a picture of Figure 1 from the paper, because this isn't just about a slightly better score.
It's about fixing the most glaring error in modern finance.
The visual irony. Fama-French had a legendary failure point, an open secret among academics.
Portfolio 15.
Portfolio 15. So to test these models, researchers divide the entire stock market into 25 portfolios in a grid based on size and value.
And Portfolio 15 is the extreme corner of that grid, the absolute smallest and most extreme value stocks, microcap, deep value garbage.
The Fama-French model was completely blind to it. On a graph comparing expected to actual returns, you want all 25 to line up on a 45-degree line.
But Portfolio 15 was always way off the line. It was a massive, embarrassing error. They couldn't price it.
Fama and French just threw their hands up and called it an anomaly. I think of it like a broken GPS.
Yeah.
It gets you down the highway, but every time you visit this one specific neighborhood portfolio 15, it drives your car straight into a lake.
And Petkova's model.
It's the military-grade satellite upgrade. It maps every single pothole.
When Petkova plots her model on that exact same graph, Portfolio 15 physically moves on the chart. It snaps right onto the 45-degree line.
It hits Portfolio 15 with absolute uncanny perfection.
And it does it without even knowing those stocks are small or cheap.
Because the model knows something deeper.
Yeah.
It knows that microcap deep value companies are the epicenter of macro sensitivity.
They are the most exposed to default spread shocks because they're tiny, and term spread shocks because they're low duration.
It is terrifyingly elegant. And now we are pulling back another layer. We are talking about the ghosts of the past.
This is where we challenge how you think about time in investing.
Fama-French only looks in the present second. It's entirely unconditional. What is your book value today? Done? The model has severe amnesia.
But a true ICPM model has a memory. It remembers the ghosts of historical data.
Conditional information.
Yes. Petkova proved that historical interest rate spreads, that the yield curve looked like last year, are deeply baked into today's risks.
By using lagged variables, it listens to the ghosts of the macroeconomy. The old model is completely deaf to time.
Now, a skeptic might jump in right here. They might say, wait, interest rates, yield curves, isn't this all just predicting GDP?
But it's just GDP argument. If GDP goes up, stocks go up.
Petkova preempted this exact critique. She drops Table 9 on the skeptics. It's a masterpiece of statistical isolation.
Walk me through Table 9.
She mathematically, surgically removes all GDP news from the macro data. She strips out factory output, retail sales, physical production.
She takes GDP, zips it up in a quarantine tent, and runs the entire regression again without it.
And what happens? The four macro shockwaves still price the stock market perfectly. They survive the removal of GDP entirely.
The shockwaves don't need GDP.
Asset pricing isn't about factory output. It isn't about how many physical trucks Ford manufactured.
Then what is it about?
Pure, raw financial panic and opportunity. It's about the cost of capital, liquidity. Fear moves infinitely faster than GDP.
Let's bring this crashing into your immediate reality, the real-world echoes. I want you to look at the history we just lived through.
Think about the decade following the 2008 financial crisis. Why did value stocks perform like garbage for a dozen years?
Everyone remembers this. Post-2008, value investors looked like idiots. Magazine covers declared value is dead.
Look at the macro environment. Interest rates were dead. The Fed pinned short-term rates to the floor, 0%.
Quantitative easing flattened the term spread. There were no macro shockwaves.
The water was perfectly still. Without term spread shocks, the value factor had no fuel. It was an engine with no gas.
But then, suddenly, the world changed.
2022. Inflation hits. Central banks panic. They hike rates faster and more violently than they had in 40 years.
Massive shockwaves to the T-bill rate and massive inversions of the term spread.
And what happened to value stocks? They woke up violently. They suddenly acted like heroes, crushing growth stocks.
Petkova predicted this exact behavioral dependency in 2006, 16 years before it happened.
Because value stocks are nothing but slaves to interest rate shocks.
If you don't deeply understand these hidden shockwaves, you will always be a victim of the market.
You'll buy a good company, watch it tank 30% in a month, and won't understand why.
You'll blame the CEO. You'll blame algorithms.
Yes.
But the truth is, you were just standing on the wrong side of an interest rate earthquake.
Staring at the umbrella, complaining it didn't keep you dry when a hurricane hit.
We are entering the twilight of the old gods. Let's hit the rapid-fire minimalist conclusions.
Conclusion 1. Size and value are not real fundamental risks. They are proxies, the mask.
Conclusion 2. Value is term risk, a derivative of the yield curve. Size is default risk, the raw fear of bankruptcy.
Conclusion 3. The macro shockwave model achieves a total dimensional strike against the old ways. Fama-French was not a genius invention.
It was a lucky net. They threw a net into the ocean to catch fish, and they accidentally caught the shadow of a nuclear submarine.
They mistook the shadow for the object itself.
Look at the terrifying reality of the global economy right this very second.
We see heavily inverted yield curves across the globe. The term spread is distorted beyond recognition.
We see skyrocketing default risks. Marginal companies trying to refinance debt at triple the rates.
The conditions for violent macro shockwaves are perfectly primed.
And since your safe value ETFs and small cap ETFs are really just highly sensitive tripwires,
You are holding a portfolio of tripwires, and you might not even know it.
I want to leave you with this golden thought. The true essence of asset pricing isn't found in boring static numbers on a balance sheet.
It's about understanding what your assets will actually do when the shockwave hits.
Look at your portfolio right now. Are you really betting on a company's intrinsic value? Or are you just blindly gambling against a future shockwave you don't even see coming?